Hi, I'm Joyce. I'm the Portfolio Manager of the United SGD Fund. The United SGD Fund finished the year at -2.31%, which is the only second negative return since 2008. Notable detractors in the fund can be attributed to the rising interest rates and the widened credit spread among Asian investment-grade credits. Notwithstanding, coupon income offset some of the negative returns. Asia Credit had a challenging year in 2022 since global financial crisis. This was driven by the Fed rate hike in the US, the ramification from the war in Ukraine, China's adherence to zero-COVID policies, severe and continuing downturn in the China property sector, and regulatory risks in China. Despite the challenging year, the fund maintains its track record with no instances of credit default. While many of the 2022 issues remain risk factors in 2023, we may usher better performance for Asia Credit this year. We're expecting a slowdown in rate hikes and even a potential pause as a possibility. We believe that the stabilization in the rates will reduce volatilities in Asian credit. We also believe all-in yield, which is the highest since 2009, will provide sufficient margin of safety against higher interest rate or wider credit spreads. Finally, we think China's economic and social reopening will help to improve investment opportunities and the market sentiment. Even as the path towards living with COVID and restoring normality to China's economic and social activities will likely be uneven and choppy, the government's direction appears set in our view. Short-dated bonds continue to offer good carry and risk rewards. With the interplay between higher level interest rates and slower growth, or even recession risks, this creates a potential wide range of outcomes. Hence, we continue to maintain our preference for defensive positioning in quality credits with leading market positions of systemic importance and in defensive sectors. Thank you for believing in us. We expect returns of the fund to resume its positive trajectory for this year. While fixed deposit and 6-month MAS bills looks attractive now, investors may need to have an eye to build wealth beyond the immediate short term. Given the recent sharp increase in interest rate, short-duration fixed income instruments now provide an attractive level of yields. The running yield of the United SGD Fund is about 4 to 5% currently and provides a good avenue for wealth building over a 2 to 3 year investment horizon. Bond yields at 4 to 5% might provide returns similar to some of the traditional equities without the corresponding volatility. Given Singapore inflation at 14-year high, it may be necessary for investors to consider investing to preserve their purchasing power. We believe bond funds can provide long-term enhanced returns by investing in undervalued bonds with attractive yield pickup. So, investing in short-duration fixed income fund like United SGD Fund might be a good way to offset inflation.